Okay, well, everybody that's joined by now, if you haven't joined, maybe you're watching this in the replay. Today we have Steve Peterson with us. Steve is the broker and also the owner of Infinity Investments, a commercial real estate brokerage out of Oakland. He's specialized in income-producing properties. The first time I spoke to Steve is, I want to say about 4 years ago, and this was on top of a three-story apartment building in Stockton that was called the Marina Courtyard Apartments. And I can assure you there was no marina and there wasn't even a courtyard.
No courtyard either.
There were, however, about 50-something apartments that I thought were too expensive at the time. And now I would think they weren't also all that expensive. Whoever bought them ended up buying them, probably doubled their money by now. But that ended up not being me. So before I give it over to Steve, I just want to point out that Steve is also a CCIM. Not all commercial brokers are a CCIM. That's a certified commercial investment member. That requires quite some additional education that Steve went through, and now he can wear the official pin for that too. With that, I'll give it over to Steve, and he'll tell us about doing deals in a creative way, which, as we were just talking about before we switched the recording on, is now more important than ever. Because putting a deal together is easy if the bank is easy and forthcoming with the money. Banks right now are still lending, but they have quite a lot of restrictions, and you might be able to work around that if you get a little bit more creative. So, Steve?
Right. Well, thanks, Chris, and thanks, Ryder, for having me on. And I think it's just what you said, we've got to put our hats on, our problem-solving hats in this environment as we move forward. As like what you're saying, interest rates are low, but getting a loan from the bank in the commercial real estate and investment world is becoming more and more difficult. And so we've seen this before, not too long ago. And so there also are some alternatives. So that's what I want to talk to you guys today about. I've got a presentation, I'll run through it in regards to creative financing. And my understanding of your audience is more of a sophisticated investor audience. So I'll go through the presentation. If you have some questions, we can kind of leave that at the end. We'll maybe fill some questions and kind of take it from there. And
Great.
So what I'll do, if I'm able to here, is to share my screen and pull up this presentation.
And we're also going to, if you haven't gotten a chance to look at our little survey, I sent the link to that out. So we'll discuss that at the end as well. But I think it'll be kind of interesting to get everybody's perspective on real estate and where we think the economy and the markets are going.
Yeah, I'm very interested to hear the results of that one myself.
Yeah, me too. In the marketplace, everybody's got a different opinion right now, so it's it's interesting. So just Chris talked about me and my company, Infinity Investments. I started the firm in November 2009 when there was literally blood on the streets, and so it was a great time though for investors that were buying. We didn't know at that time where the bottom was, but what we were able to do is figure out, hey, these properties actually cash flow. And working in the Bay Area, we hadn't seen cash flow for quite some years. So it was a good time to buy. I started the company. I've also had the honor of serving as president of the California Association of Real Estate Brokers and the Associated Real Property Brokers. Those are the state and local Oakland chapters of NAREB, which is the National Association of Real Estate Brokers. That's the Black Brokerage Association. I also had the honor of serving as president of NorCal CCIM. Chris talked a little bit about what CCIM is. That's a designation that stands for Certified Commercial Investment Member. But more importantly, it's a network of commercial real estate professionals that are dedicated to the industry. And I had that great honor of serving as president. So I learned some stuff. I learned how to work with people, learned how to process deals and analyze a lot of properties in unique situations. And our company specializes in the brokerage and acquisitions and syndications of mid-sized apartment buildings. We do other commercial, doing a lot of office right now, and we do some residential investments as well, but our sweet spot is mid-sized apartment complex. I like to think of those between 5 and 50 units. And that's kind of been our sweet spot over the years. So that being said, let's get to the nitty gritty. We're talking about creative financing and why creative financing. And I think now more than ever as we move forward. So I've been saying to everyone, I think the last few months have been what I've been calling a grace period. A lot of the banks have given their clients, mortgage forbearance. A lot of people are working with each other, but at some point in time, the rubber meets the road. People are going to have to make their mortgage payments. Things are going to get maybe a little bit difficult. We've already seen it. I track defaults, and I've already seen an uptick this month in August here in Oakland with commercial defaults. Also, I track what's happening in Stockton. I've seen an uptick as well. All right, and the pandemic has affected us. I think the number was the economy shrunk by 32% last quarter, which I thought it was actually more than that, but that's a huge number, right? And while what's interesting, like in a place like the Bay Area, house prices are still going up, right? And I think that has to do with the 2% money that's out there. But what's going on in retail? What's going on in office? What's going on in hospitality, apartment buildings? Things are a little bit different, right? Properties are still trading, right? But it is beginning to be a really difficult time. And I think in general, a lot of sellers have equity in their properties. So as we transition, I don't think that we're going to see this huge crash in prices that we saw in 2008, although I could be wrong. I think we're going to see a lot more creative situations where a seller says, hey, I've got a ton of equity. I can't sell my property at the price at the market value. Maybe I can take back a note. Maybe I can lease it out with an option to buy. Maybe I can, carry a second. Maybe I can do a joint venture. Maybe I can do one of these creative things that has been done through the centuries, if you will, definitely through the decades in the past, and is a way of making a transaction happen where we're not solely dependent upon the bank. I think that is very, very critical. And so as we go through the presentation, I'm going to break down, some of the benefits of creative financing, and then I'm going to talk about some of the methods and get into the nitty gritty of the methods and how you can implement them in your deals. Now, just saying this, I think also every market's different. In the Bay Area, traditionally, it has been a lot more difficult to work creative financing deals. I will tell you, though, I started in real estate and commercial real estate in 2003. I have done creative real estate deals all from in each market, up, down, all around, whether that's someone carrying a first, a second, a lease option, whatever, raising capital. I've been doing these types of deals my whole career. And so there are times where they're more prevalent and there are times when they tighten up. I think we're moving into a time where it's going to be more prevalent. Okay, let's just break it down exactly to see what is it though. When you hear this term creative financing, I think it gets used very loosely. And essentially, I just think it involves a real estate transaction where property is being acquired using capital that's not derived from a traditional bank lender, and or capital that is blended with bank loan, but maybe is not coming from the purchaser of that property. So in other words, and this could take several different forms, but essentially we call it creative because we're structuring a transaction where we're using some form of other people's money, whether that be the seller's money, whether that be a partner's money, whether that be some sort of a mezzanine investment structure on the bigger deals. But we're figuring out how to put capital in play that is not always from the bank and is not always from you, the purchaser. And if you've been in real estate for a long time, I got in 03. What got me in the business was I was at San Jose State University and I saw this infomercial called No Money Down Real Estate by Clayton Sheets. And I ordered the course, and that's what got me going into real estate, because that course broke down all these multiple ways of structuring deals. And he was big on no money down. A lot of creative deals still involve some money down, but it's not where you're putting all the down payment. Commercial 25 to 35% down is typical. And so there's many ways to structure these acquisitions to where you're either not going through the bank at all or you're minimizing your down payment. And I think that is a great way for sellers to sell a property as well when they understand that. Usually sellers just say, I want all my money. And in a regular market, like we've seen the last few years, they've been able to put the property in the market, get 10 offers. There you go. As we transition, I think they're going to be a little bit more open to doing some of this. And when they understand the benefits, of helping them to get their price, when they understand the benefits from a tax standpoint, it actually makes a lot of sense to structure a deal creatively. All right. Now, here's some of the benefits. We talked about doing a deal with very low money down or no money down. My first deal was a 6-unit apartment building in Pueblo, Colorado, where I did a master lease option on it. I put $1 down and I borrowed $1 because I didn't have it. But that was a form of a no money down type of transaction. I've done several of these type of transactions where there was low money down, less than 25 to 30%. I think that's more what we'll see. And it also allows you to purchase a property larger than your current cash available, than the capital that you currently have available. So let's say you have a few $100,000, but maybe you see a great opportunity. You can partner with someone else or ask the seller to carry financing, and that would allow you to purchase a property more, where your existing capital may be limited. So that's a great way to stretch your dollar as well. Now, you can also obtain a mortgage from a seller if you have less than stellar credit. That's another thing that is, when people are doing acquisitions, maybe they had something ding their credit, and they find a seller who's willing to sell and they work something out. Typically, sellers are not out there running your credit, although they can. But you can also negotiate and talk to a seller. Whereas if you're talking to a bank, they're just they have a box. They're working on a checklist. People you're talking to are people, but essentially they're just pushing the loan through that assembly line. So when you're talking with the seller, you can negotiate and you can create. Okay, and that also helps out when it comes in terms of the actual terms of the loan. Okay, because you can negotiate that. You're not limited to, hey, the bank says this is what it is. Okay, now this is what I like to say. Okay, you can significantly increase your rate of return also by putting less money down. But here's the thing: on a property that has positive leverage, meaning that the interest rate is less than the cap rate. Okay, so if the cap rate is 5 and your interest rate is 6, that is negative leverage. If the cap rate is 6 and the interest rate is 4.5, positive leverage. So when you put, let's say, 10% down versus 25% down in that scenario, and the interest rate on the first loan and then the second is less than your overall rate of return, now you've increased your rate of return on that 10% down pretty significantly. Okay, that's probably one of the best benefits of creative financing and why it's used on some of the bigger deals. Now, you can also control and profit from a property without even owning it, and that's using options or land contracts. So it's a great way of getting in the game. It's a great way of stretching out your dollar. It's a great way of increasing your rate of return, and also maybe controlling assets without being fully committed to them. A lot of developers, by the way, will control land via an option before they go out and get all the financing, because they want to go bring it through the city, they want to entitle it, and then go and get the financing. And a lot of them do that with these creative strategies. Okay, now that's all fine and dandy, but why in the world would a seller agree to this, right? Why would the seller agree to this? Now, first off, I think now in this climate that we're going into, there are some capital gains tax advantages. We'll talk about that, but this allows a seller to get a higher price than they would get if they just are selling it straight up conventional for cash. In general, in the creative financing world, we're negotiating as a purchaser, Mr. Seller, I'll give you your price, but I want my terms. Okay, give you your price, my terms, meaning that the seller can get their price. Now that may have to be stretched out over time, but this is an investment, and sellers who are looking at the bigger picture can wise up to the fact that they can maybe get their price. They just have to stretch it over time. Okay, but then also that minimizes the amount of capital gains taxes that the seller would have to pay. And it can also provide a stream of cash flow to the seller with security. And it's a really passive form of income to the seller, because we all know, especially in the apartment building world, even if you have a property manager, that you still have a variety of things that you have to do in terms of operating that property. So when you, as a seller, sell it, now the owner is responsible for dealing with all of that. All you have to do is receive a a check. That is a great way of really converting your equity into a form of passive cash flow while minimizing your tax liability. Now, it also helps the seller to move a property. And this is where you have to be careful, okay? It helps the seller to move a property that is just not attractive to other people. In other words, maybe it has high vacancy. Maybe it is in a really tough neighborhood. I've seen this a lot. Maybe it has really bad deferred maintenance or really bad physical issues to the point where the bank will not lend on it. And again, we talked about lending tightening up. A lot of back in the Great Recession, there were a lot of great deals out there, right? But a lot of the great deals were 60% occupied, 70% occupied. You could buy them for the value of that cash flow. The challenge was you couldn't finance them traditionally, because the vacancy was too low. So you had to go with hard money or partner up or get some other kind of loan, because the bank wasn't going to give you a loan unless there was like 80 to 85% occupancy. So another way for a seller to carry is if their property has high vacancy, a lot of deferred maintenance, and the bank won't lend on it. But you, as an acquirer of this real estate, have to be careful that you don't want to just do a deal because the creativity of the financing. The deal still has to make sense, and that's the one thing I want to continue to talk about. I did a presentation a couple of weeks ago about opportunity zones and group investing. And the key thing I said there, same thing with 1031 exchanges, is that you've got to do the deal based on the merits of the deal. The financing, the opportunity zone, the deferral of capital gains, that's icing on the cake. The deal still has to make sense fundamentally, okay? Because you can get into a bad situation just because the seller was willing to carry. That doesn't necessarily help you out, though. Okay, and I really want to drive that home as we get into these strategies. All right, now, a couple rules of thumb, like I was saying. All things considered, we're negotiating for terms, not so much for the price. However, you don't want to overpay. Okay, you don't want to overpay, especially a lot of times creative financing is done in the short term, 2 to 3 years. If you can get a creative deal stretched out 5 years, I applaud you, and I think that in your negotiations, you want to ask for a longer term than you're willing to take, because especially in this pandemic, man, we don't know how long this is going to last. And there's not really a clear-cut playbook on, hey, this is how we deal with the pandemic. We can look back and say, oh, hey, here's how we dealt with the Great Recession. Here's how we dealt with the dot-com bust. Here's how we dealt with savings and loans, inflation and interest rates in the 70s, the Great Depression. But as far as I know, we don't have a playbook on pandemics in the global economy. So we don't know how long this is going to last. Stretch out your term if you can. But the bottom line is you're not trying to beat them up on price and get them to carry. You got to, kind of understand that, give them their price or a reasonable price and work your terms. All right. Still make sure the property is suitable from a cash flow standpoint and have an exit strategy. Now, here's the last piece on the rule of thumb. Also, a lot of these deals get done outside of traditional title companies. I think you still need a quality escrow company that can get the documents properly recorded. A lot of this stuff will happen private party. I've seen this firsthand back in the early 2000s. I did a lease option deal in Santa Clara County, and they wouldn't let us record the option at that price. Now, I didn't know what I was doing. What I should have did is went to an escrow company that would have recorded the option, because you absolutely can and should record options. But I went to the county recorders. They said, nah, we don't record these things. Get out of here, kid. And so I didn't record it. And, I wish I would have recorded it, right? So make sure that you get the necessary documents properly recorded. If you're not going to go through Old Republic, First American, there are a bunch of escrow companies that can help you out with this, making sure that the documents are properly recorded. All right. That being said, all right, let's get into the meat and potatoes. I want to set the table. I wanted to build the foundation. That's important. But now we're going to get into some of the sexy stuff that I think you might be interested. So here are the basic techniques that I've learned about and have implemented. Master lease options, and we just say master lease options for you guys out there that maybe are doing residential deals. Same thing as a regular lease option. Just once you have more than one unit, it's now a master lease. You're master leasing each unit. Okay, land contracts and contracts for deeds, as we call them in the state of California, Every state, they're different. Essentially, these are installment sales. Wraparound mortgages, which is a all-inclusive deed of trust, as we call it in the state of California. Seller carried first and second deeds of trust, which is the traditional, this is the more traditional way of seller financing. Something that's very interesting, joint venture partnerships. This is done by, again, a lot of developers will joint venture with someone who has a plot of land, and they'll bring the equity and the expertise. The partner has the land, and they put together development. The newer, I won't say newer, but crowdfunding is become very popular as a result of the Jobs Act back in 2012. And, putting together capital from self-directed IRAs, investors with self-directed IRAs, and 1031 exchangers in the form of syndications has become very popular. It's been around though for forever. I just think with the internet, we have more information around about that. And so it's a great way of structuring a deal. Now there's opportunity zones, which is a little bit more complex, but another great way of using other people's money creatively to structure a deal. Now, the last one is more of an institutional measure, but still, some of you guys may be scaling up either now or you're in the future, and you may be looking to employ preferred equity and mezzanine structured finance. What these are large firms who place equity or mezzanine debt structures behind first position loans. So in other words, let's just say the property's $20 million, the senior lender's in at 14 mil, there's a $6 million equity need, the sponsor comes in with 1 million, and then remaining 5 million, let's say a mezzanine lender comes in and puts that mezz piece on top of the first loan, or preferred equity comes and puts that equity piece. It's on top of the first loan, but it is an institutional deal. These typically start at 3 million. Some companies out there will do it 2 million, but they start at 3 million, meaning the deal's got to be like 20 something million. So that's more of an institutional deal, but all of us can play ball in that space either now or eventually, right? Some of you may be there already. So these are the techniques. I'm going to break down each one. And I see a few chats coming in. I will get to them. I just want to go through this information, and at the end, I will certainly come to you guys. So let's just start with the basic one. Seller carry back first and second deeds of trust. And in Cali, we call it deeds of trust. It's a mortgage, right? It's a security against the property. But note that, and me and Chris were talking about this, the language is different from state to state. So make sure if you're going to invest out of state, which I, am a proponent of, get familiar with that language and some of their rules, all right? But bottom line, a seller carried the first or second deed of trust. When you do the deal, the deed will transfer at close. You'll see through some of these other techniques, it doesn't always transfer. But in this method, it is a traditional sale where the deed transfers at close. Now, the seller is taking back either a first or second, they could potentially do both, but usually it's either or, a first or second deed of trust in association with the promissory note that spells out all the terms of the loan, just like a bank does, but you can negotiate these things, all right? And typically, most sellers want to do this in first position, in my experience, but what I see a lot of, and this is where I think guys pay attention, that we'll see a lot of sellers willing to take seconds in this market, because the buyer can come and say, well, I can go out to the bank and get 65-70% leverage, no problem. Well, we know it's a little bit tougher, but they can say, I can go out and get that from the bank, and I can get it at 3.5-4%. But what I can't get from the bank is that second going up to 80, 85, 90% CLTV. Mr. and Mr. Seller, would you be willing to carry that in second position to go up to 85, 90% CLTV? I'll come in with 10%, 15% down, but I stretch my money out. I can therefore, instead of me beating you up on price, I can give you your price. You just got to take back some of that equity over a period of time. And it's spelled out in the terms of the note, whatever you negotiate. And again, like I was saying before, try to stretch that term out as long as you possibly can. I think this one is going to be more prevalent than sellers taking back first positions, because this is the gap money. This is where a lot of the sellers' equity is at, and they don't want to just give that away. If they can sell it to you and you give them their price, and you negotiate, again, you have to negotiate favorable terms though. You don't want to kill yourself in this. It can make a lot of sense. Now, sellers typically are not going to run your credit score, but they might. Okay, and so just be prepared for that. And even if you had some credit issues, you can again, you can talk to a seller. Whereas if a bank runs it and they just say, you're 1%, you're 1 point under our limit, just now we kick you out. With the seller, you can have a discussion, and we can negotiate, which is kind of a lost art these days. But you can do it, all right? And this is just the traditional way. This is the easiest way to get this done. Again, you got to make sure these documents are properly recorded. Very, very important. Now, sometimes the lender does not want a second position loan behind their loan. Every lender is different, though. Some lenders will say, nah, no way. Now, if they say, nah, no way, then what you got to do is record it outside of escrow. And then figure out a creative way, to get enough money into escrow that satisfies them, and then record that deed outside of escrow with another escrow company not handling that transaction. Okay, that's legal. However, you want to be honorable in terms of dealing with your bank. You guys can figure that out, though. All right, so I just want to point that out. So the next one is the master lease option strategy. One of the best ways of acquiring real estate, in my opinion, is the master lease option strategy. Okay, and it's essentially when you take over operations of the property by leasing the entire complex. Okay, the same thing as if you were to lease a house. Let's say we're dealing with the office building. Again, I think this is going to be big in office. So somebody comes and says, Mr. Seller, why don't I lease your entire building? That way we get some income coming to you. I'll take an option for the next 5 years, and within 5 years, I'll pay you X price for this property. In the meantime, we're going to pay you some money each month. And when we pay you that money, we want a percentage of that to go towards our purchase price. The same thing as a regular lease option, except for it encumbers the whole building. All right. This is a great way for you to take control of an asset without having to go get a loan. Now, the key is there does need to be typically some option consideration. I'm moving around a little bit on this, but typically option consideration is anywhere. It has to be something. So it can be $1. I mentioned my first deal was $1 down. I did have to borrow it though, but it was $1 down. Typically it'll be anywhere from 1 to 5%. I put 3 to 5% here. You want to put the least amount of money down, because when you give the seller option consideration that purchases your option, that money's gone. It's not coming back to you. It does get credited to the purchase, towards the purchase price. So if you're able to follow through on your transaction and close it out, that option consideration is basically like a down payment that gets credited towards your purchase. And every time you make a mortgage payment, you want to negotiate an amount of the monthly rental amount to get credited towards your purchase as well. That represents somewhat like a principal payment equity builder, if you will. Now, here's the key. I bounced around on this a little bit, but I want to point this out. An optionee, the one who receives the option, receives equitable title, which is the legal rights to the title. You do not, let me point this out, you do not receive the title until you fully exercise that option and purchase the property. At that point, the title, the deed transfers to you. So this is very important because you have rights to the title. You control the property. You do have a form of ownership. You have equitable title, but you do not own that deed outright. Okay, so that means if you want to go out and get financing, you can, but it has to be acquisition financing, not refi. Okay, big important thing to point out here. Excellent way to do a deal though. And a seller who would be open to doing this is someone who is looking, who maybe, again, having problems selling the property, but also is having management issues, or they're burned out on management, and you can come over, take control. They just kick back. They get a monthly lease for the whole building. So again, someone who's burned out, trying to maybe sell a property, who can't sell a property, or doesn't, not being able to get their price, you come in, you solve the problem, and then you improve the property. Now, when you do this, you have to have a way to improve the property, or it's going to be a lot of work for not much return. Okay. So that's another thing. Again, the fundamentals of investment doesn't change. You got to make deals work based on the numbers, and you have to find a way to add value to the property while you own it. It's the same thing. It's just we're talking about getting in and creative ways to do it. Okay. Now, land contract and contract for deed. Sorry about the screw. It says contractor for deed, but contract for deed. Okay. Language is different. In California, they are called contracts for deed. In Ohio, for instance, where I've done a deal like this on a 58-unit apartment building, it's called a land contract. There essentially is installment sales. And installment sales are just what they sound like. It's a sale broken up into installments, okay, where the down payment or even the entire purchase price is broken down into payments. This is very similar to the lease option in the sense that when you execute this contract, you get equitable title or rights to the title, but you do not receive the title outright. You have rights to the title so long as you fulfill your covenants of the installment agreement and you come through. And when you come through, you then receive the title. Important point to note here and also on the master lease option technique is that you can sell the property while you are, don't own it technically. You can line up a buyer who wants to buy the deed outright. And if you're going to do this, you probably want to do it higher than your option price or your agreed upon installment sales price. That way you make a profit. But you certainly can do that while you own the property. And it's a great way. A lot of investors do this. A lot of developers do this. I mean, there's guys who've been around who just simply do lease options and installment sales and make a ton of money. Okay. But you don't get the deed. That's the important piece to point out. You do get control and you can begin operating the property and bringing up the value by bringing up the rents, if you will. Give you an example. I did this on a 58-unit apartment building in Columbus, Ohio. We took control. We did have to put some money down. Okay, again, you've got to put something down. It could be $1 or an amount. I don't suggest you putting more than 5% down though, because that's a lot of money to put at risk without owning the deed yet. So whatever money you do put down, it's gone. It's not like earnest money. You don't get it back if the property doesn't work. It's into the deal. So you got to make sure you do your due diligence, right? So we did this. We put, I think, $100,000 down. It was $1 million apartment building, but it was 50% vacant. What we did is we got the property 95% occupied. It went from 50% vacant, which is 50% occupied, to 95% occupied, all in a matter of about 4 to 6 months. After we got it 95% occupied, we then went to the bank and said, hey, we'd like to get a loan to purchase this property. They looked and saw 95% occupied. Here we go. So that's a great way of using this strategy with minimal to small amount down. And very similar to the lease with option to buy, a couple of different nuances, but it's a great way to do a deal. Now, wraparound mortgage is my favorite, and the language for it is an all-inclusive deed of trust, which in this example, the deed does transfer at close. Okay, this is very similar to the residential world, taking over a property subject to the existing loan. However, it is different because we are creating a new loan that is then going to wrap around the existing financing. Okay, essentially, we create a new loan that wraps around or encompasses the existing financing, and typically will include the existing financing and the seller's equity above the existing loan amount. Okay, give you an example. I did a deal like this in 2008, right before the crash. I was the listing broker, and we got my client out in the nick of time because he was, it wasn't working out for him. We put the property on the market. I want to say $750, and it was having a tough time to sell. We got an offer that was interesting, where the buyer said, "Hey, I'll give you $750, but I only want to put $100,000 down, and I will wrap around. We'll create $650,000 loan that wraps around your." I think our loan amount was about $5 or $550, right? So what happened is they put $100,000 down, right, at close of escrow. The deed transferred, went from my client to the buyer. $100,000 got put down. Interesting for you brokers and agents out there, I got paid full commission, all right, out of that $100,000, out of the down payment. Now the buyer puts the $100,000 down payment. We execute a new mortgage in the amount of $650,000. That $650,000 new mortgage in favor of my client, the seller, wrapped around my client's existing loan that was between $5 and $550. Okay, the deed transferred to the buyer, close escrow. So what happens is, now the risk in this, guys, is that the bank didn't know about all that. Okay, the bank wasn't privy to that. The bank didn't approve it, and the bank wasn't asked to approve it. Totally legal way of doing a transaction. Okay, just the bank didn't know about it. Okay, so what happens though after close is the buyer makes the mortgage payments to the seller. Seller takes the mortgage payments, makes the mortgage payments to the bank. Okay, what in doing so, you have to put a neutral third party in place, and there's all kind of different escrow companies that'll do this, to where they receive the payments from the buyer, and then what they do is make the mortgage payment directly to the mortgage company, and anything left over they send to the seller. Then they do a proper accounting of the transaction and get documentation to each party. Okay, a little bit complicated, but that's the best way. That's the best practice on if you're going to do a wraparound mortgage, because there needs to be proper documentation. If you're the seller, and there is risk here, bottom line, if you're the seller and you're doing this, okay, you got to make sure when you get that mortgage payment, you pay the mortgage. So the best way to do this and take the liability off you, get a neutral third party to accept the payments and make the payments. And if you're the buyer, you got to make sure that seller is making those mortgage payments. Again, the best way to do it is have that neutral third party. Okay. Key here, guys, there's a risk involved. The bank is not aware of this. The bank is not approving it. The bank can call the loan. If they find out about the transaction, which interestingly enough, in this deal they didn't call the loan though, because the foreclosure crisis had begun. Okay. And they were, working through the deal. But the reality was that is a real risk. And that's also a risk, like for you guys doing subject to financing, where you just maybe give the seller a down payment, some cash, and you take over their existing loan. That's not assuming a loan. Now you can go through and that's another form of creative financing, doing a formal assumption, but that's not what we're talking about here. All-inclusive deed of trust, wraparound mortgages, when you create a new loan that then wraps around the existing financing and the deed transfers. Excellent way of being able to do this, do a deal, but there's risk involved, okay? I think we'll see a lot more of this as we see sellers getting a lot more flexible, and particularly in the world of retail and office property, okay? So, being able to sell a property and have somebody come in with the creative idea of being able to operate that property, this is a great way of doing it, okay? And we'll keep this train rolling. We're just gonna wrap up here soon. Now we're going to talk about syndications, okay? Again, this is another form of creative financing. It's just now a little bit tougher, because maybe you try to structure this deal with a lease option, or maybe you try to structure it with the seller carried first or second, a wraparound or installment contract, and the seller just said, you know what, nah, I need my money. I need that. When we close escrow, I don't want to have anything to do with this property. I want to take my money in 1031 exchange, or I just want to take it and go to, wherever I'm going to retire. So, but maybe you don't have all the cash to buy that property, and it's still an excellent deal. So now it's time to raise capital from investors to help you to acquire the property. There's several different ways of doing this, okay? Joint venture partnerships, and when I say joint venture, the legal structure of joint ventures, or as we call them, joint tenancy, not a good way of doing it. You want to legally put together an LLC or LP, limited partnership, but I think LLCs are the best way. Talk to your attorney, talk to your tax folks if you're putting this together. But there's a legal entity, typically an LLC, where there's multiple members or multiple managing members involved in the LLC as partners, not necessarily passive investors. And I'll give you an example. Bought a fourplex in 2013 where the investors are, we're all like partners in it, but it was done through an LLC where I was the managing member and the other investors were also managing members. And we, there was ownership interest. I was 20%, they were 40-40. Okay. And we made decisions. We made them as a group. Okay. And we operated together. And they were not passive investors. We were kind of partners in a deal, but through the LLC structure, very important, we were able to, do that deal. I did that deal with no money down. Okay. And I took that deal down with hard money, and then raised money with investors. So that's a way to do it. Now, there's also a way of doing it where you go out and acquire the property, and then you put together like a private placement memorandum. When we're talking about here, where we're talking about crowdfunding, where you go out and raise capital from passive investors, where people are not, they're limited members and they're not involved in the management, and they're just getting a rate of return. So there's some security laws you have to pay attention to, and a great way of accomplishing that goal is putting together a private placement memorandum, which is regulated. It's part of the legal world of the Regulation D capital raise, and it's a great way of going out and raising capital in terms of acquiring a property from people who just want to invest. They don't want to be a part of the management. They don't want to be a part of the decisions. They just want to put up capital. By the way, there's a bunch of people out there like that. Okay, and there's a bunch of people who are in 1031 exchanges or have self-directed IRAs or sold a company and want to put some money in the Opportunity Zone Fund, where you can structure an entity to go out and raise capital to acquire real estate that you have identified. Okay, the key here at the end of the day, you got to find great deals and be able to have the wherewithal to communicate the economic benefits of the deal to potential investors in a way where they're going to see themselves making a return and there's still an economic benefit there for you. You don't want to do all this raising capital and doing stuff just to be giving them a rate of return and make some small fees. You got to make sure that if you're putting this together, that you're making it worth your while and that you're following the rules. Okay. You can also, just put together private promissory notes from individual investors like in IRAs to invest with you as second or third position lenders on a deal. That's another way. Okay. Bottom line is, if the deal makes sense, you can go out and raise capital in a variety of different structures. Talk to your attorney, talk to your tax folks, get as much knowledge and education. There's a guy by the name of Gene Trowbridge. If you Google him or pull him up on YouTube, he's got a great book. I believe it's called It's a Whole New Business on syndications and raising capital the right way. Check that out, guys, if you haven't. Excellent book. Okay. Now, hard money and structured finance. This is like your last resort, guys. You know what I mean? Hard money is, okay, a private money loan, 65 to 70% loan to value, typically, where the property is either so beat up you can't get a regular loan. You go to a private money, or your credit is so beat up you can't go to get a loan from the bank. Okay, so it's an equity driven loan. They're going to stick it to you in interest rate. Okay, they're going to stick it to you in points and fees up front, and it's going to be a short-term loan, typically 1 to 2, 2 to 3 years, rarely 5 years. But if you can find a 5-year hard money loan, that's a great term on a loan. Now, when they give you a loan like this, they still the LTV is going to be only 65 to 70%. There may be some lenders, and specifically outside of California, you might be able to get higher leverage than that. But all things considered, it's going to be about 65 to 70% leverage on that. Now, I talked to you about the bigger deals of commercial real estate involving mezzanine loans. Mezzanine loans are basically it's a fancy word for second position deeds of trust. But a lot of them involve, if there's a deed of trust, but they also involve you pledging some of your equity in the LLC. So it's a blend of debt and equity, okay? And this is done on institutional type deals where the equity required is at least a minimum of 2 or 3 million, and they like to do bigger deals. So that's why I say this is like the last result. Or if you're doing bigger deals, this is an option. I worked on a deal like this in 2007. It was a $24 million acquisition of a 336 unit apartment building in Katy, Texas, where I was part of the team that acquired it. I didn't acquire it, but what I did is raise capital for it. There was an $18 million first position loan, and we raised $4.5 million from Arbor Commercial Capital, which was a mezzanine loan. And then we went out and raised money. I raised $1 million from a boutique private equity firm out of Miami. They put up $1 million, which is essentially in third position. Well, it was the third equity position. So it was money on top of money. Okay. And that was an institutional deal. And that can be done, but it is complex. It is complicated. That's your last resort. Okay. Now, cross collateralized loans, I don't recommend them. The reason I don't recommend them, that's when you have a bunch of properties you own, ton of equity, and maybe you're trying to get a loan on a new property, but the leverage, maybe you're trying to get 80% loan to value. And the lender says, well, I will give you 80% loan to value if you let me put a second on your other beautiful property. Which means if the new property you buy screws up and you lose it, they can then come after your other property, which is why I don't recommend it. But it can be done if you think that the deal is that great. It's a way of using your equity in one property to help you to purchase another property. Very risky. I'd like to see you maybe go raise money from a partner or ask the seller to carry or move on than just taking that approach, because it's risky. And joint venture equity, this is also becoming popular. I've seen a deal like this where, you got to find a wealthy family individual who says, hey, I want to put up a cash to buy properties, but I don't want to manage it. So I'll put up all the cash, you manage it, and you get 10 to 20%. This is less likely in real life, but I know a few people who've done deals like this where, somebody's really wealthy, has got a lot of cash, but they don't want to deal with tenants, toilets, and problems. You deal with that, and then you split the equity. But what happens is they pretty much run all the show, call all the shots, and as for you, the person who actually is feet to the ground, that can be very annoying. So, just take that with a grain of salt, if you will. And that wraps up our presentation, and I'll stop the share, and so we can get to some questions here. But I'm kind of going fast because I know you guys are a little bit more of a sophisticated group here, but I wanted to make sure that we spend some time, if there is some questions, if you will, because there's a lot of nuances in this. There's not really one deal that is alike. There may be similar, but in the world of creative financing, the biggest thing that I love. So Clayton Sheets, some of you guys may love them, some of you may hate them. In the real estate world, everybody's got different opinions, but what I loved about that course was he mapped out all the ways of creative financing, but he also, in that course, teaches you how to analyze property. But he had what's called the creative options grid, which is if the property is like this, then this method or technique is the best way. Okay, if there's no equity in the property, then look at it, do it this way. If there's a bunch of equity here, because there's not a one size fit all. That's the biggest thing I want to say to you guys, is that it involves of creatively working through some problems. So hope that was helpful. I would love to get into some questions or whatever we got right now.
Yeah, Steve, thanks for the presentation. Great as always. As far as that grid, I think maybe it's safe to add it on to your presentation, because I think Clayton Sheets just passed away in January. So
I heard about that, man.
Yeah.
I just heard about that. It's too bad, man.
Yeah, well, he was 80 years old.
Yeah.
But he did real estate right through the end, I think.
Well, it was the thing. I never went through the boot camp and everything, but I ordered that course. And I mean, I went through it about probably 10 to 15 times, and that's what got me going.
Yeah, and that's probably 10 to 15 times more than most people that ordered that course did. I think there's a lot of ways in which you can make money, but all of them involve you doing something. And I think that's the step that most people, except for you, get stuck on. Okay, so as far as questions, one question, there's a bunch of them, and Ryder also probably has a couple of favorites, but one thing I think is a big deal, and I think a lot of people will be asking that. Somebody asked, so, okay, this is all nice, I kind of understand how this all works. Where do I find these people that are willing to do this, and how do you even, talk them into it, right? Yeah. So I think that's an important question. Could you speak to that a little bit?
Yeah, absolutely. And like I said, right now, we're going in a shift. So if there's a property that's listed on the market, probably is not your best candidate for it today. Although I do think that may be changing, because what I'm seeing on LoopNet and Crexy is I'm seeing several properties, like in the city of Stockton, which I'm all over right now, several properties that have been on the market over 6 months.
Yeah.
And if you're on the market 6 months, that would be now you might approach them. But here's what I think you got to do. I think you got to prospect deals like a broker or an agent, meaning that, or the other wholesalers and investors that are professional, you got to go after properties that are not yet on the market. So I use a couple programs. I use propertyradar.com to help me to track the defaults. I use Prospect Now as a method of giving me phone numbers and mailing addresses for people who are owning properties in my farm. So the farm, and by the way, a farm, that's your territory. You got to kind of have a territory. I think I'm of the opinion that you can go out of state. I think in real estate, you're going to find 20 different opinions on that. So you go with what you go. If you're in your own territories, you need to look at some zip codes and dial into an area where you can farm, and you send some mailers, make some phone calls, drive some neighborhoods. And when you drive in neighborhoods, what you're looking for is those for rent, those Home Depot for rent signs. The one that says for rent, but it's like written and you can barely read it, because that's not a property manager, that's the owner. And they're having, by the way, in the Bay Area, I just got a call from someone saying, "Hey, I have a beautiful Victorian in San Francisco. I'm having trouble leasing it out. Can you get the word out to your database?" Because renting properties is becoming very, very difficult right now, even in the great city of San Francisco. So roll your sleeves up and go after the deals off market.
Yeah, and I would also say, and I was hoping you would say this, so you could promote yourself, but like, if getting after properties, driving neighborhoods, calling people, if that's not your thing, find someone like, for example, Steve, and say, "Hey, Steve, this is kind of what I'm looking for. If you come across something, let me know." And of course, Steve doesn't work for free, but you'll get one more deal than you would otherwise. So it's find people to help you, is what I'm saying. There are people whose job it is to find whatever sort of properties it is that you're looking for, whether that be single families in Kansas City or apartment buildings here in the Central Valley. There's people that do that looking for you for a price. But you can expect them to work for free because you're not doing that either. So find people to help you. You will not find these things in a market where there's 11 offers on every single property.
Right.
Yeah, and if it's a listed property, that's, call for offers. There's not even a disclosed price because they just want people to go crazy. That's probably not where you're going to be able to do creative financing.
Right. And you gotta, when you're working with brokers like me, the thing about it is we're out there pounding the pavement. You don't have to pay us out of it. We get paid on the deal. You know what I mean? And typically the seller pays it. And so we're always prospecting. Not every broker understands it, but you talk to the brokers in the market where you're working and put the feelers out, because guys who been around, they know that this is coming back around, So that's key.
Ryder, do you have any favorite questions? We got a bunch.
Yeah, I see a question here. If you're talking to a seller, how do you transition or bring up the topic of, "Hey, let's try a creative financing solution"?
Well, so, okay, a couple things on this. Now, there's a few different opinions. I'm of the opinion that, first of all, you want to go through a series of questions to determine the seller's motivation. So you want to ask the seller, well, why are you selling? Are you going to be doing a 1031 exchange? Are you retiring? Have you identified the property that you want to purchase? How concerned are you with capital gains taxes? Is this property, you love this property, or do you hate it? Because what happens is you need to figure out if in your mind, if they're a candidate for, you don't want to just call them up and say, "Hey, are you willing to carry financing?" You got to finesse it. So through a series of questions, then you can figure out where they are. And I typically will, on the first call or first conversation, I'm looking to just build a conversation, build a relationship, build some rapport, get some basic information, go back and do my research. And then I always like to schedule another time to get down to the nitty gritty. And on that second meeting is where I'll typically bring up the ideas. If we can get you exactly the price that you want, are you open to carrying any part of the financing on this property? Only then that I like to do that, because I've at least established at that point that they've got equity, they can do it, or that they are even open to do it, or they're a good candidate to do it. Because if you just come out to them up front, "Hey, you want to carry financing," that even if they're open, even if they would, what you've done is you've thrown up a sales barrier, and hopping over it's going to be tough. So you got to ease it in, and first of all, go figure out if they're a candidate. If they are, then figure out, okay, then you can do your research. Roughly, I think the property's worth X, they owe Y, so they've got equity. They said that they were wanting to move to, people who want to get in retirement are great for this, because they also have to think about, if they sell this property, they're going to have to 1031 exchange. I mean, they got to buy another property. So if not, they're going to pay taxes. So if they can carry for you, they kind of solve both problems, if you will. So the direct answer is, my advice is, on the second call or meeting, not upfront, unless through conversation it comes up. But build that rapport first. Do your initial contact, get the meeting, and then on the second meeting, come back and pose it if it's a possibility, and then just kind of take it and go from there.
When you're trying to, I mean, all this is predicated on you're talking directly to an owner. If they have already listed with a broker, in your opinion, is that kind of like, okay, that's not really going to work for me, or do you still try to get in touch with the owner?
Okay, great question, because here's what I think we're talking about market, right? I do think we'll start shifting. And speaking as a broker, if now I understand this, right? And I invest as well. If I'm having problems selling a property, most of the time it's because the sellers don't want to drop the price. I think a lot, like I just mentioned in Stockton, a lot of those buildings have been on the market more than 6 months. Whereas if it's priced properly, it should sell, right? And then prior to the pandemic, those buildings were flying off the shelves. So something's going on where it's sitting. Now, it's not all bad. If it's listed, you still can ask, especially when you see that the property has been listed for a long period of time. I have done this. I've done lease options. I've done seller carry first and seconds with the sellers on a listed property agreeing to carry some financing. And in fact, I'm in contract right now on a deal. It's a land development deal here in Oakland, which is a pretty hot market, where the seller, before the pandemic, before that stuff, agreed to carry the first position note. It was listed. So it's not the kiss of death if it's listed, but I think look, I have an office building for sale. I put it on the market last week. I got a couple offers. I have a call for offers Monday. They probably not carrying financing on that one, right? But let's just say that property's set for 6 months. I would, as a broker, come to them and say, if you want your price, or you want to sell the property, one of two things. You got to reduce the price. That's just the reality. Or you got to do some kind of carry-in financing. Otherwise, you're not going to sell it. We are going to see more of those situations for sure. So it's not all bad, but it's least likely. Because really, most of these brokers, they don't know how to structure the deal where they can get paid, which is the problem. And so if a broker knows more, it's why I'm teaching all of my agents. I got 18 of them, and we're drilling down on this, because I think we need to be creative to move properties in the future. Maybe not today, but things are changing.
Do you think the broker would be a filter that you might not want to have in between? And would you say, like you just ask them, and if they say no, you move on, or would you try to contact the owner anyway directly?
Well, that's a good question. Okay, so if you're licensed, don't contact the owner directly, because you're violating the law. Yeah. But if you're not licensed, you can. It's all fair. This is the big boys and girls of the world when talking investments. If you're licensed, you gotta be careful, because if you call them directly.
Yeah, and the goal here wouldn't be to cut out the broker, right. But the goal here would be to have that conversation and to prevent that from getting stuck in the filter with someone who, like you said, a lot of brokers do not truly understand this.
Right. And they think that if they do this creative deal, they can't get paid. So if you can talk directly to the decision maker, that's usually the best way to go. Sometimes these people are like really difficult to get a hold of, though, which is why, like, for instance, as brokers, we're constantly out there talking to people about selling their property, and some of them are just hard to get a hold of, but if there's an impasse and it doesn't seem to make any sense, you do want to go directly to the seller, not with the goal of cutting the broker out, because remember, the seller is paying the broker, but having a direct conversation where you can communicate directly kind of what's going on. And sometimes those brokers are, they're not creative enough to figure this stuff out.
I think that makes sense. We have some questions that are a little bit more detail oriented. And for those, I would recommend, Steve, you're going to throw your information up on the screen, right? So
you want me to put it? You want me to put it in the chat?
Yeah.
Great. Okay. Well, I'm just going to put my website and then my YouTube station, because most of what I'm doing is on the YouTube station. And if you hit us up on the website, you can book an appointment to talk to us, see our deals and all this type of stuff. But check out our YouTube station because we're putting out our content all the way, all of our content's on YouTube, and I think we got some great content that's out there. And what I'm trying to do, as a broker, as a business person, really, as we expand our company, we're in this pandemic, my shift or pivot, everybody is saying pivot, so I'm trying to use different words, but my shift is that I'm really working on utilizing technology to operate the company. And so I'm asking people, book an appointment with us online versus calling us, because if you go on our site, you can book an appointment to talk with us like this, versus if you call in and I don't answer, someone has to get back to you and it's a back and forth. First, just go to the website and book it, and then we're online, we're on Zoom, and we can talk.
And so that way you can be sure that it's at the time that you have the time to dedicate it to, and it's not like I'm driving and I need to get out of my car. Right.
And that's my transition. And I think all of us, we got to look at whatever our business is. Real estate's an essential. Housing of people and businesses is essential. However, the details, the terms, the rates, the financing, all of that stuff is up for grabs, up for negotiation. But we all have to figure out what are our halftime adjustments during this situation. And we don't need to have a crystal ball, but we do need to be able to think quickly on our feet and figure out a way forward. Absolutely.
So Ryder put out the survey earlier. It looks like we got some responses. Ryder, do you want to cover it so we can see where people are at with their minds right now? I've been pretty interested to see this, because I know how I feel about things, but I don't have a lot of perspective.
So we don't have the crystal ball, but we do have, like, everybody puts their crystal balls and we put them all together and see what it looks like. So looks like 21 responses, and if anybody hasn't submitted yet, you can always add to this and increase our data accuracy. So we asked, what is your outlook on the U.S. economy? And there were a couple of multiple choice options. It looks like our most popular, 43% of people said, I'm not sure which way this thing's going to go, which makes sense. I think that's the safest answer. And then 28%, or 6 out of 21, say this is a recession like 2008. Chris has been reminding me again and again that this is technically defined as a recession already, because we have two.
Yes, that is one of my stick horses, but people say, oh, I don't feel like this is a recession, or I don't like, but it's not a feeling. It is like, it's either freezing outside or it's not freezing outside. It's anyway, that's what you get when you go to school for economics. You got stick horses like that. So what do people's outlooks look like?
So then we've got, so I think to summarize this, people are either like, I'm still not sure, or this is a recession, which is on the lighter side of, I'm scared as heck. This is a depression.
Most people seem relatively optimistic, more optimistic than I would have thought.
Only a temporary setback is our third most popular. So that's good. Dude, it's crazy how much of, especially the stock market is just on perception.
Stock market is 100% feelings and consumer. The only thing that you're investing in is that you think that other people think that other people feel about it a certain way. Seriously, that is what the stock, it has nothing to do with the underlying values of the stocks, of the companies, or of the revenue that the companies made. If people, it is just a game. And it's like an emperor's clothes where nobody points out the obvious.
Right.
And that's why I don't particularly, I'm not big on the stock market, because you have no control over this game. If all of a sudden people feel irrationally depressed or irrationally optimistic, the value of your stocks just goes either up or down. It has nothing to do with how you analyze the company, how you pick the stock.
Yeah. It's crazy. It's crazy, right?
Insane. Yeah.
It's
casino, basically. where you bet on, you don't bet on the sports book, you bet on what other people will think of things that they're not qualified to have an opinion on, by and large. And then at the more granular level, you're competing against algorithms that have determined that if they sell in this millisecond as opposed to 3 milliseconds from now, that they will do better at the end of the day. It's pretty crazy. And even though you might think you have control, and over the last 10 years, to be honest, if you would have invested anything stock market, like a Dow Jones, like an index fund, you would have done okay.
Yeah.
Now, does that hold for the next 10 years? Over a long enough timeline, you'll realize like a 7% increase. And that is given like you don't panic sell and you don't panic buy. You just keep on going.
Right. So what is the broad outlook on the U.S. residential real estate market? Most, again, pretty optimistic.
Yeah, it's
too early to tell. So far, so good. And then third most popular, the crash is coming.
I think, like Steve pointed out earlier, we have not seen the worst of this yet. I think a lot of that has to do with the enormous amount of money that got pumped almost willy-nilly into the economy.
Right.
Some of it got given directly to people with, those T-shirt guns that they have at hockey matches.
Yep.
or those money guns that you'd have to shoot off the mezzanine at a club.
Yeah.
It's kind of that's what they did. And so far, it's actually helped us from, from totally cratering. It's going to be interesting to see what's going to happen when that runs out. I don't know, Steve, what you've been seeing, but for my residential portfolio and also for our self-storage, people have been paying kind of as they were so far.
Yeah, and it's interesting that in the apartment world, a lot of people have been paying, which is great. This is really good.
They've been stuffed with money,
But that's okay. This is like 2006 and 2007, where there was defaults mounting up, but nobody paid attention to that because the money was so easy to get. You could say, if you had a 700 credit score, you could literally write on a piece of paper, I make 300,000 and get $1 million loan. And so things continued to roll, but the writing was on the wall. And I don't know if we're going to have a crash like 2008. I just don't see how this train can continue the way it is because it's based on monetary policy, not necessarily fundamentals. Economics.
I think two things. The government has been pumping a lot of money into the economy, like an extreme amount of money, which I think was the right thing to do given the extreme circumstance.
Right.
But secondly, also the interest rates right now are so incredibly low that a lot of deals still kind of make sense. So there's still people wanting to buy for no other reason, if any, just to have those low interest rates and lock those in. I think those two things have been doing a lot to prop things up. But you do have to ask yourself, if people don't have a job anymore, how are they going to pay for stuff, including the place where they live? How are they going to pay for that longer term? That it would be like... I was thinking it would have been worse by now, but it isn't yet. But it's hard to imagine that we won't see very serious effects. I mean, I keep telling myself I invest in C-class apartments. People need to live somewhere, right? The alternative is, to say it harshly, under a bridge, right?
Well, it's the reality.
Yeah, people need to live somewhere, right? They cannot you cannot move down much from a C-class apartment. And you could move out of an A-class apartment into a B or C, but from a C, there's not a lot of places to go, particularly since you won't qualify anywhere else.
Right.
But then on the other hand, I've been seeing these proposals in California where they say, no tenant may be evicted for the next, 15 months, with the landlord not being compensated. I don't see how those sort of things would work.
Yeah.
It's still pretty scary, and I'm surprised people are so optimistic. But I must say...
with that $600 stimulus...
Yeah, that helps.
I read 70% of people on unemployment make more than they did working.
And so I have a client who has a tenant, and tenant's behind on rent. And he said that my client owns a fourplex. He's a project manager at a construction company. He reached out to the tenant, hey, we are hiring. Come on out here. You make $25 an hour, basically just sweeping stuff. The guy told my client, only if they'll pay me under the table, because right now I'm making more money on unemployment, although he's not paying his rent though. But what you just said, Ryder, is an issue and a problem. Many people are getting more money for sitting back than they were in their regular job. So what happens is they are conditioned to just kick back and not go grind it out. And then when that rug gets pulled from up under them, there's not going to be that many jobs to go back out to.
I do want to say though, and I totally agree, but I do want to say though, if there ever was a time to pump money into the people that are most likely to spend it, which is the people way at the bottom of the ladder.
Right.
Now is that time.
Now is the time, though.
Because right now, I don't think the problem right now overall as an economy is that we can't find people to do work. Because there's so many jobs that were lost. So if ever there was a time to overpay people unemployment,
this is that time.
This is that time, because this will make that money not trickle down, but trickle up. Because those are the people most likely to spend it. To be honest, if you give me another $1,200, I'm not going to go spend it on anything, because I don't, it's not that that changes my life. But if you're, one of my tenants, you're a lot more likely to pump that right back into the economy that we're trying to keep going in the first place.
And that is why a lot of people are able to pay their rent, because of that money that we are talking about. And so, it'd be interesting to see how it goes forward, if and when that stops. I hope they extend, like what you're saying, Chris, because they we all kind of need it right now.
If ever there was a time, and I don't even want to think about what this means for the national debt longer term and the inflation that we'll have to rack up in order to get rid of that national debt. But it's if there ever was a time to overpay people in the lower segment, then now would be it. Because like I said, it's not like a problem, despite these people that are now getting paid more on unemployment than they did in their job. The general problem in the economy right now is not that there's a lot of jobs going unfulfilled. Are there some? I'm sure there are, but that's not the big deal right now. So there's still a lot of people looking to buy.
Let's get through these. When do you think unemployment and the economy will recover to pre-COVID levels? The most popular answer was 2022. That would be my guess as well. The second most popular is late in 2022, late 2021, and a couple of people think early next year.
I think I was part of the purple group there. I think these, like a lot of the jobs that went away, they're just not there anymore, and they need to be recreated. And that's going to take time.
Yeah. Bottom line, it just takes time. I think it's after 2021, because think about where we were before COVID. This thing was rolling. I mean, it was rolling like never before.
Yeah,
you know what I mean?
And you might argue, how many yogurt shops was it really sustainable to have in a single mall, right? But hey, it definitely was like I don't think we've ever had numbers like unemployment numbers that low ever before.
When
I went to school, like I said, for economics, I didn't even know that was possible. I was always told that about 5% was normal unemployment, because that's the transitional number that you get from people moving out of one job into the other one.
All right. Do you plan to make a real estate purchase in the next less than 3 months? So the most popular answer was wait and see.
Yeah.
So most people aren't sure if they're going to make a transaction. 5 people in the next 3 months, 1 person in 3 to 6, and then 4 in 6 to 12. I think I'd put myself in the wait and see camp.
Yeah.
Yeah.
Me too. I think the issue, they're not the issue, but the people who are buying right now, like sophisticated people who are buying, are in either exchanges or opportunity zone type deals, or in a situation where they kind of need to buy in order to not pay taxes. But most everyone else is kind of saying, well, let me just let's see which way the wind is blowing and then make our move.
Yep. It's not like the interest rates are about to go up anytime soon.
Right.
Yeah, that's for dang sure. Do you think the Bay Area real estate prices will drop in the next 12 months? So the most popular answer was yes, 5 to 10%. I would I might be on the darker end of this scale. I think it could be as high as 15 or 20%.
I do think one thing in the Bay Area, though, is that a lot of people have jobs, the people that own houses, at least in the Bay Area, not people that rent, but the ones that own, they typically tend to have jobs, I think, that are at least initially less affected, since they can work from home and they don't require them to be anywhere. So and also those might be the sort of people that are less affected by, by the pandemic overall. Are you seeing a lot in San Francisco where you live, Ryder? Are you seeing a lot of people, that would own a home in San Francisco that are struggling right now?
I've never seen so many for sale and for rent signs for this long, like ever. On my street, usually if something goes up, it's pending within a week. And I've seen some up for 5-6 months.
Yeah.
It's like unbelievable, especially for rent. Usually for rent, it's like 2 or 3 days.
Yep.
I've seen some sitting there for months as well.
Yeah, that's crazy. I literally just got a call from a property manager saying, can you get the word out about this apartment they're renting? And that's in San Francisco.
Renting, yeah.
Yeah, that's crazy. I haven't never experienced that, but that's what we got going right now, guys.
Yeah, and my friend Flavio, he does a lot of transactions in the Bay Area, and so he has a good pulse on things, and he's saying the condos, really hard, really slow moving condos. Yeah. But if you're in like Alameda and you got a yard, if you got a pool, it's like a bidding war. Yep. It's never been so hot. People are just, their tastes are changing. They want a yard. They want more space. They want to be in the burbs.
Yeah, that's what's going on right now. I mean, that's what it is.
So then we asked, do you agree with these? Which of these are true? Will there be an exodus from big cities? 71% of people agree.
Yep.
Retail commercial real estate is in serious trouble. 86% of people agree.
Yep.
On that one, I'm interested. If people have a commercial lease and they're walking away, I know for residential, there's probably going to be no consequence if you can't pay your rent. What about commercial?
Well, yeah, I mean, there's consequences because the land, but it all basically breaks down to the landlord's, in my opinion, ability to go after the tenant, because the landlord, again, you can go after that tenant, but it costs money. There's no free legal defense for landlords, and especially in commercial, you're going after corporations in generally, not all the time. So a lot of times it's small businesses, but you got to figure out, is it worth going after that tenant?
Are you going to sue the Cheesecake Factory and win? That's the question.
Exactly. And this during the pandemic, right?
Yeah.
How are you? So, I think in some cases you'll see it, but a lot of landlords are not going to have the resources and wherewithal, or just want to direct their time and attention elsewhere versus going after these guys. However, there's publicly traded companies who back out on their lease. Have to report that. That you talked about stock market. It might not even affect their stock price.
It hurts their credit rating?
It definitely hurts their credit rating. It should hit their stock price. It just should, downgrade their company at the end of the day. It should, but we don't know. Well, I say it should. It's just in the way it works. You know what I mean?
Robin Hood investors will be like, oh, they're cutting costs.
Yeah, stock should go up. Stocks should go up. It might. I mean, who the hell knows, right? But it's going to be a problem somewhere for them. But they may just say, screw it. We gotta live to fight another day. And I think as entrepreneurs, you run in a company, you do have to make some tough decisions. So that you can survive and then come out of this, So it is what it is.
So then we asked, if the government wasn't providing stimulus, would things be worse? 71% said yes.
Worse.
Is the rising debt a big problem? 76% said yes. Really interesting. at 25% of the entire economy is government spending right now.
Yep.
That's insane. And part of the reason the GDP didn't decrease more is because government spending brought it up quite a bit.
But that is how the Keynesian model works, though. Where,
yeah, exactly.
If the economy is going great, the government pulls back, and if the economy is not doing so great, the government stuffs money back in the hopes that that'll accelerate itself into more money, and at least doesn't make the thing collapse on itself. I think I sent Ryder a screenshot of one of the formulas that is used to calculate that. It's quite complicated, and I think now the Keynesian model is not holding up anymore either. It's pretty.
Also, we forgot to run surpluses during the good times.
Right.
Yes,
That's
because
the key.
then for some reason we found something else to spend it on. You know. There was probably an aircraft carrier in need of painting somewhere, or
right.
Yep. But on the other hand, though, if you're the most powerful economy in the world with the most powerful army, you know, when you have a great credit rating, you can rack up a lot of that. And who's going to come after you, really? Because you do have that freshly painted aircraft carrier.
Well, yeah. I mean, that's one thing you got to think about, because as this thing you talked about,
that is kind of how it works, though.
Yeah. Bottom line, I mean, right?
Yeah, and that's, you know, and I'm not saying it's with evil intent, but it is the reality, though. If you're the one of the biggest, freshest painted aircraft carriers, the chances, like your credit rating in the world will hold up, and as long as there's people willing to borrow from you, and that don't see a problem in the fact that your payments at some point exceed the GDP, you can keep that going for a long time. And then I think the idea is to inflate yourself out of it. And if that happens, I hope that I have most of my wealth caught up in, you know, assets that will be tied to the ground, that will float up with the inflation, and that I don't have it in a savings account, because that'll people that have their money in cash or savings, when there's a lot of inflation, they will get killed.
Yeah,
they'll lose everything basically.
All right. And will there be a wave of foreclosures? 71% think there will be.
Yeah.
How can there not be? I've seen some people, and I know why most of my tenants move out, because they give a reason, and a bunch of them went and bought a house, and I kind of know their payment patterns, and I think some of them were not, you know, probably good candidates to buy a house. And now with everything like this coming on top of it, I think a lot of people that just bought a house over the last year or two with, like, you know, a 3% down sort of thing, they're not going to be, you know, wanting to hold on to the house even if they can, because they don't have equity.
Right.
So yeah, I think there's going to be a big adjustment. Would you agree, Ryder, or do you think, you know, people will be able to hold on to their houses?
I think, I mean, the wild card for me right now is what the government will do. Because if they hadn't already stepped in, I think we already would have seen a much bigger correction.
And there's forbearance too. But now let's say they stuff another 3 billion or 3 trillion into the economy, right? And let's say they increase the forbearance time and all that. Then basically we're going to be, you know, we're going to get a vaccine somewhere later on, and then now we're towards the end of next year. And the economy, all those jobs, like I said, some jobs will come right back because people can go back to their company, but some companies are gone, and those jobs are not there until they're recreated. So there's going to be a big gap, I think, over the coming years that I don't know how people would hold on to it. I think the only thing that might save us is that there were a lot more people wanting to buy a house than there were houses.
Right.
During the last housing crisis, there were a lot more houses than people wanting a house. You know, that's why every hairdresser had like 3 investment properties that were just basically being refinanced. And that was how the mortgages were being paid, out of the refinance money. And I don't think we were in that position now. I think we still hadn't caught up to the population in building property. So, but people still need jobs to pay for the mortgages, though. It's
well, not if the government just gives them a check.
Well, and I think there's two different worlds. There's the single family house world,
Yeah.
and then there's commercial. Well, and then there's residential investor world,
Yeah.
and then there's commercial world. I think we'll see the pain first coming in the retail and office hospitality.
Yeah, absolutely.
And I'm telling my real estate agents, we're tracking all the defaults. We've already seen it this month. There's an uptick in the Bay Area in commercial defaults. I think that will be the wave before residential. But at some point, we're going to see some residential foreclosures too.
Yeah, I don't think that'll be anytime really soon, though, in between the forbearance and all that money that you're talking about that's being pumped into the economy. And then again, if there ever was a time to pump a lot of money into the economy, then it's now. I mean,
it is now.
this is worse than what we had in the early 2000s. This is way worse than 2008. This is the worst that anybody alive right now has ever seen. And it doesn't feel that way. I mean, I haven't seen very long bread lines everywhere yet. I'm not saying they don't exist, but I'm saying that to a large extent, that money pumped into the economy has been able to, keep the hardest edges hidden, at least. But when that stops, what are we going to see?
Well, that's the scary part, and that's the part where we, as folks who are spending our time on a webinar this evening, need to prepare to be leading the charge. We can't just sit back and wait. We've got to have game plans. I think that's critical.
Yep. Good. Do you want to wrap us up, Ryder?
Yeah, I think on that. Steve, we really appreciated your time, your insight, sharing so much knowledge with us. You've dropped your information in the chat. We'll also do a follow-up email to share this recording, and we'll incorporate your information as well. So really appreciate it, and have a wonderful evening.
Yeah, my pleasure being here, guys. Thanks a lot, everybody. I appreciate y'all.
Thanks again.
Thank you. Cheers.